We are gearing up for the weekend, which means we're going to be recording audio podcasts for Saturday and for Monday. So hang out here with us. We're going to talk about big change. If you watch Bobby's Instagram earlier, we swapped it up the last second, which is what we like doing on the show. When there's big news, we're going to cover it. We realized we didn't do the Fed. The Fed just had big news yesterday. So we want to talk about that. And then we can't, Bobby, do anything without talking about Kanye West. We have to talk about Kanye.
Yes. Do you know what this is a fun fact. I took an entire course on the Fed when I was an intern at CNN at the advice of Myron Candell, who was sort of a mentor there.
Great idea.
Because I did not understand the Fed. So I literally took like a 6-week course on the Fed because it just made no sense to me. I also didn't understand the concept of yield and interest rates, but we'll talk about that.
No, and that's why we want to cover this, right? Because most people don't. I mean, most people have no idea. They see this headline that says the Fed does XYZ, and the first thing you think is, what the hell does that mean to me? What does that mean? Like, who cares?
I still don't get everything sometimes because economic policy changes. You know, they say these words like quantitative easing and all this stuff, and you're like, what does that mean? So. You know, Joe will explain everything to all of us, so don't worry. Joe knows everything.
You think I know? I don't know. I'm only on my second, well, actually, I lie. I'm on my third cup of coffee today because we started, and it is 9 a.m. Pacific time, and this is my fourth thing of the day. We started.
I haven't been outside with masks on because I've got lipstick on still. So there's my University of Pennsylvania medical.
Go Penn. Go Quakers.
Yes, although I don't think they're having any football this year. Last I heard. But what do I know? They're changing. A lot of football at school is changing. So I'm glad they're finding ways for players to play safely.
Tate and I on the episode that dropped today, that's what we talked about, was the Big Ten doing that, moving into football. So Ron, dumb it down. Ron, you know, if anybody can make it dumber, I can make it dumber. Like I'm your guy to do that. Oh my God, I'm so ready. Tomorrow, we are out exploring. We're going to go explore this. I don't know if you're familiar with the Saul-Sehy, this stinky inland sea that's right here by Palm Springs. So
No, it's funny because I've been to Palm Springs once. I was scheduled to go literally right before everything shut down in mid-March. I was supposed to be going. So we canceled our trip days before we were supposed to go. But I now have family out there and I should be out there a lot. But with everything going on, we're just not doing leisure travel. But I loved it out there. We didn't make it to Joshua Tree. They have a great zoo out there, actually, that we did.
Cheryl went yesterday.
Cheryl
went yesterday to that zoo.
It's an awesome zoo, guy. I know it sounds weird. We're like the zoo, but trust me, guys, it's a cool zoo. It's a really awesome zoo.
You did. There's
there was like baby goats and stuff. Right?
And she showed me the train set at that zoo. Like there's this big outdoor train set that's fantastic. Yes.
They do a great job. We love Palm Springs.
Sucker for trains. But anyway, there's this big inland sea that there was a big accident. It's a long story. There's a 99% Invisible show all about this. So if you like good podcast, 99% Invisible is one of my favorite shows. But so they go all into the Salton Sea. But what happened was there's all this water got trapped, made this big inland sea. And in the 1950s, and even before that, there's all these people that can't afford the West Coast, right? They can't afford beachfront property, but they could afford out here in the desert. So they built up all these communities, Bobby, around this inland sea that supposedly, would be a great place for middle-class families. Well, this water got trapped and it's in the desert and there's all this salt and stuff. So the sea got stinkier and stinkier and just ugly and things changed. And now the fish are nearly almost all dead that are in the sea. It supposedly stinks all the way around, but it's 75 miles around it. Like it's a huge thing. And, but the weird part about it, and the part I want to see, there's all of these ghost towns, and they're not ghost towns like you think of a ghost town from the 1800s out west. These are ghost towns from the 1950s and 60s where people abandon it because the property's worth nothing because nobody wants to live by this stinky, ugly place. And so we're going to go drive around it. I've heard that there's a bunch of art installations out there now and this cool retro 50s
Wait, but is
vibe.
it still stinky?
It is very stinky. Yeah. In fact, our mutual friend, Jen Ma, who is up for a Plutus for Community Builder, I was talking to her yesterday. She goes, you need to wear a mask, not because of COVID, but because it smells horrible. And I said, well, actually, I think we're just going to drive around it and leave our windows up. She's like, that's great. She said, it's really cool, but it really stinks. So Saul-Sehy happening tomorrow. And then Joshua Tree this weekend. So should be
very fun.
All right, guys. Anyway, that's what Joe's doing this weekend. What are you doing this weekend?
It is the Jewish New Year, so I'll be celebrating the Jewish New Year. We're going to have a small outdoor, very, very small gathering at my sister's. So I'm looking forward to that.
That's cool. Cheryl is Jewish as well, and we're going to celebrate it by hiking. So
that's great.
Enjoying nature. All right. Yeah. Are we ready to make a podcast?
Absolutely.
Oh, wow, Ron. I bet they're over the banks in Georgia. I can't imagine. We were just in Mobile, and I'm watching the hurricane coverage, as I'm sure you are, Bobbi, and just looking at what's going on with the hurricane has just been just ugly. And by the way, Mobile, a town I didn't know much about until we were just there. I love this part of exploring America because these cities that I didn't know a lot about, Mobile, Alabama, just beautiful, beautiful place. All right. Let's make some podcasts. I'm going to hit record.
Right. We're doing, it's Saturday, September 19th it's going to be, and we're doing the Fed story, right?
Deal. You just announced it for the recording, so bring it.
All right. The Fed will keep interest rates near zero until 2023. It is Saturday, September 19th. Let's talk money with our friends. Welcome to the Money with Friends podcast. I am certified financial planner, Bobbi Rebell, host of the Financial Grown Up podcast, coming to you from my very grown up kitchen in New York City.
And coming to you from Palm Springs, California, where we make episodes of the Stacking Benjamin Show, my mom's basement. I'm Joe Saul-Sehy.
This is the Money News Show that includes commentary on recent headlines and stories with thought leaders from across the financial landscape. We break those stories down into what matters to you, our friends, and we leave you with a takeaway to make it your own.
Today's show is brought to you by Tiller Money. Optimize your financial life in Google Sheets with fast automatic transaction imports, easy templates, and a free 30-day trial. You can learn more by heading to tillerhq.com/MWF. Bobbi, the Fed just decided not to make a move, but they just had some guidance. And you and I were talking earlier. I love doing stories like this. This is why the show exists, because the Fed comes out with these announcements and you go, what the hell does that mean? What does that mean to me? Yeah. Today, maybe we'll get to talk about what it means.
Yeah, let's see which one of our friends is going to bring us into the story.
All right, today's piece comes to us from Forbes. It's written by Sergei Klebnikov, and he writes, Federal Reserve says it will keep interest rates near zero until 2023. The Federal Reserve concluded its two-day policy meeting, the last one before the November election, on Wednesday of this week by pledging to keep interest rates near zero until 2023 as the central bank looks to continue to support the U.S. economic recovery out of the coronavirus recession. In a widely expected move, the Fed kept short-term interest rates steady at the 0 to 0.25% range on Wednesday. Central bank also signals that it would keep rates anchored near zero through at least 2023, with all but four members of the Fed board agreeing with the long-term outlook. Bobbi?
Fed officials also issued updated quarterly economic forecasts reflecting a smaller decline in GDP and a lower unemployment rate in 2020. While the economic recovery has, quote, progressed more quickly than generally expected, unquote, and Fed forecasts have been revised up from previous projections, overall activity still remains well below the level it was before the pandemic, Fed Chairman Jerome Powell said in a press conference. The Federal Open Market Committee, also known as the FOMC, expects to maintain an accommodative stance of monetary policy until inflation averages 2% over time, the central bank said in a statement. In late August, at the last FOMC meeting, Fed Chairman Jerome Powell announced, quote, a robust updating of policy in which the Federal Reserve will allow inflation to run moderately above its long-running 2% goal. The central bank's new approach to inflation is meant to support the labor market and broader economy by keeping interest rates lower for a longer period of time.
It's so there's so much going on here. And obviously we're not going to be able to unpack everything in 15 minutes, but we can do the basics, Bobbi. For you, what are the big takeaways? I mean, we're going to talk about our big aha takeaway later in the show, but what are some of the keys here for you?
Well, I think the big thing, and this is something I learned, I like to joke that when I reported on the Fed extensively when I was a business TV anchor at Reuters, I literally spent a decade reporting that the Fed did nothing. And I would joke about it, but the truth is, doing nothing for the Fed is big news. And that's something that was very confusing to me and on the surface can be confusing to a lot of people, that if they're not doing anything, why is that news? Well, this is news because by saying we are not going to move interest rates as much as they can control, and they can control a lot, until 2023. It is 2020 right now. I don't remember ever seeing a forecast that far out. I remember, maybe 6 months and so on, but we never really have heard such a long outlook. So to me, the length of the time frame that they're talking about is very big news. It signals that they are nervous about the economy. If they thought the economy was going to power up, they would be expecting to raise rates to slow the economy. So this to me signals, well, we're going to keep supporting the economy because we think the economy is going to need that support. They did not, however, say anything to my knowledge about negative interest rates, which is something they've had in Europe. So I personally, I don't think negative interest rates are a good thing. I think that has not been a great experiment in other places. So I also think that hasn't been something that they've been talking about doing here.
Man, do I agree big time. What scares me about this long range view that the Fed has is behavioral economics, right? When people hear that I've got 2 years to get my debt figured out because interest rates will be low, so I can consolidate, I can refinance my debt, I can get my house in order, and finally get lower interest rates so I pay less money to, quote, the man, and more money goes actually to my debt. I feel like people see headlines like this, Bobbi, and they go, okay, that means I don't need to do anything today. I can put this off till tomorrow because we all have a lot of stuff that we need to do today, tomorrow, whatever. And hey, I'll put this off for a few days, but then days become weeks, weeks become months, and we do nothing because we see a headline like this.
That's a really interesting perspective. What you point to also is the fact that the Fed is only one piece of the puzzle. If you put off, for example, refinancing, other things could change. For example, one of the reasons the Fed is saying this outwardly and making such a public statement about supporting the market and effectively providing liquidity is that they want people to know there will be money there. Well, why are they saying that? Maybe, you don't know that banks will necessarily want to lend to you, right? Just because rates are low doesn't mean you will have access. What if you lose your job? Or you have a salary cut, or you have insecurity in your industry, whatever, you may not qualify to refinance or to get access to the funds that you want. So what you say is a very good point, is that if you do want to refinance, you probably absolutely, you're going to have more time for rates to be low, but that doesn't mean your personal situation will allow you to have that loan.
That's a great point. Do it now because there's so many different factors. And another piece of this then, the next domino here, I think people don't understand is that the Fed, while it influences all these different rates, it doesn't exactly translate, especially when it comes to mortgages, right? Mortgages are based on treasury rates, which often move in a much different way than the Fed moves. It's closer to the vest when it comes to your credit card interest rate and auto loans. Those are going to be based on, and sometimes home equity lines of credit will be based on what the Fed does. So while there's some correlation, it's not a perfect match. So seeing this doesn't mean that your interest rates are going to be super low forever. And by the way, by the same token, when they talk about 0 to 0.25, I've read people online saying, hey, my bank's ripping me off because I've got a 2.5% interest rate and the Fed's only doing 0. But these interest rates that they're talking about, 0 to 0.25, are these very, very short-term loans that the Fed gives liquidity to banks with. So obviously the bank needs to make a profit. So for them to have just this little 2% skim on top of whatever low interest rate they get, good for you and good for the bank. The bank can stay healthy, which I hate to say this, but we want banks to stay healthy, right? I mean, I don't really care about Bank of America.
Say that. We absolutely do want. No, but we do because they provide a tool. Let's be honest. Banks do provide wonderful tools for individuals and for businesses. And the other thing I think people need to remember is that banks we are a capitalist society. We may forget it sometimes, but banks have to, they do have to earn money, and that's part of the system. And also the other thing that affects your loan rate is the demand is that if they're getting so much demand for mortgages that they can barely process them or refinancing, which has happened, the rates are going to go up a little bit because they need to slow down the business, and they can because they can. It's a business. And also credit card rates. I mean, credit card, they could just be tied to whatever the bank wants to charge you, frankly, your credit card rate, if you've got credit card debt. So your credit card debt, not going to be at 0%. Same thing with any kind of consolidation loan. That's going to be based, sure, there's market factors involved, but it is not tied to the Fed funds rate necessarily.
No, not at all. And Kevin brings up a third point here. By the way, if you're new to the show, we perform this show live without a net on a bunch of social media channels. The best place to join us is our YouTube channel, youtube.com/moneywithfriends. But Kevin asks, do you guys think they're boxing themselves in, or do you think they're trying to bring stability to financial markets? And the answer to that, I think, is another domino that people don't understand. Bobbi, we led off by saying you've never seen it. I've never seen it. The Fed saying what they're going to do 3 years from now, whenever. And the Federal Reserve is not a government entity. They're a separate entity. Sure, they're tightly aligned with what's going on in Washington, but it's a separate entity. But whenever any Washington, D.C. based government-ish entity says something that's 3 years away, do not believe it for a second. If things change 6 months from now, the Fed's going to reverse course and they're not going to care what they pledged. So saying that they're 3 years out, I think, to Kevin's point, I don't think it boxes them in at all. I think they'll change that in a second, in a heartbeat, if conditions change. I do think they're saying that to help bring some stability to financial markets, clearly just signaling that they want to help in any way possible, which I don't think anybody doubted that. Do you?
No, I think that's absolutely right on target.
Yeah. Hey, in just a second, Bobbi and I are going to have our big takeaways from today's piece. But while I let Bobbi formulate the best takeaway she's ever had, got to say a big thanks to everybody who's gone to Tiller Money to check out what I think is the best way to manage your budget and manage your money. When it comes to Tiller, the reason that I like it is it's based on spreadsheets. And spreadsheets, while they are not always your friend, I'll tell you when it comes to Tiller, because of the fact that for me, I like the fact that they use templates. So I start off with this very simple to use template. I know that because I pay a very small subscription to use it, I'm not going to be marketed a bunch of stuff like a lot of the free solutions out there for budgeting. And I know, and this is a big key, instead of having to take all of my financial data and input it myself, which is what makes a lot of people groan when they think about spreadsheets, instead, it automatically gets inputted securely into my spreadsheet. So just like any of the popular apps out there, I get all the good sides of those apps, but I also avoid the downside, which is a bunch of marketing push to make up for the fact that I'm getting it for, quote, free. Check out Tiller, tillerhq.com/MWF. You'll not only get a free 30-day trial, but it also, if you use our link, it helps the show because they send us a thank you for sending you their way. So big thanks to everybody who's used our link, checking that out. All right, Bobbi, the time of truth. What's our big takeaway from this piece?
Joe, the Fed can only do so much, but at least they are doing that. Let's also now focus on fiscal policy as well. And by the way, as you said so well, make sure you lock in your mortgage rates, refinance, et cetera. Do all the things, because why chance it? Things are probably not going to get any better in terms of lower rates. So grab yours now.
Yeah, I do like following the Fed. I like it, especially when they lower interest rates because of the fact that may give me more opportunities to get my debt in order. I also like it, by the way, when they raise interest rates, because if I'm a saver, which is where I really want to be, that means that I might find higher yield. I might get bigger dividends, bigger interest payments on my savings. So I like it both ways for different people. The big thing, though, is I follow the Fed, but I still always want to do, to your point, Bobbi, what's right for me right now. I don't pay a lot of attention to the Fed. I pay attention to my own personal financial position. And if I can do better based on what the Fed's done, then I do it. So I really want to follow these headlines, but I don't want to put stuff off because the Fed's telling me 3 years here. Don't do that.
Very well said. No procrastination, my friends.
Do not procrastinate. Let Bobbi and I be the whip and make sure that you get this stuff done, man. Get it done.
Yeah. And you're probably home a lot more than you used to be. So no excuses, guys.
Absolutely. And there's also no excuse to not follow us on social media. How about that for a transition? How do people follow us, Bobbi?
Instagram at Money Friends Pod. That is also our Twitter handle. And of course, make sure you are subscribing to our YouTube channel where you can be part of our live recordings. And you can also get links on our YouTube channel to the articles that we talk about. They are right in the notes below.
And Bobbi and I, in meetings the last couple of weeks, have talked about how on Instagram, we're going to share more personally. We've had a lot of you help us make the shows by participating in those polls that Bobbi talked about, by giving us your thoughts. Still going to do that, but we're also going to talk about some of the behind the scenes making the show, our thoughts about some of these headlines. So do more Instagram stuff there as well. So be sure to follow that. Coming up on Monday. Monday's pretty exciting, Bobbi. We're talking about this little known artist named Kanye. Is that how you pronounce that? Kanye?
Kanye West.
We're going to talk Kanye West. Kanye, and a lot to do with your wallet on Monday. We'll see everybody back here then. Bye-bye. 1440.
All right. Speaking of